Oh man. It's like 11:40 at night. Oh my goodness, I can't even do the introduction without yawning. It's 11:40 at night, recording again. We're going over the first presented for value gap. Be appreciative of these recordings because I really should be asleep right now. If anybody caught me recording right now, or not necessarily caught, but walked in on me recording, I'll probably get in trouble. Okay, but it's 11:40 at night, and I'm here recording again for you. The first presented for value gap. And yeah, let's go ahead and get into it. The first presented fair value gap is the basically the first gap on the 1 minute or lower that forms 1 minute at the beginning of an opening range. 1 minute after the beginning of an opening range. So, for example, the 9:30 opening range. After 9:31, you want to find the first fair value gap that forms either on the 1 minute or lower. For example, if you go lower than a 1 minute, such as 15-second, 30-second, and stuff like that, then you want to find your first presented fair value gap after the 9:31 candle or 1 minute after the opening range's beginning or the beginning of the opening range, which would be 9:30. Okay, so it's pretty simple. It's not nothing crazy. It's a pretty powerful fair value gap. I've been looking at his teachings and watching this play out live, and it is pretty powerful. I'm not gonna lie to you. It is a pretty powerful concept. But first we're gonna go through these days here, where I said these no, but these days here, all the way from about the 2nd or 4th of May all the way to like 9th of May. So this all this week right here, we might go over like 3 examples or 3 different days using the first presented fair value gap. So we're gonna go ahead and jump straight on the 1 minute because like I said, you need to go to the 1 minute for this. And we're going to jump to the 6th, I think. We're going to do the 6th. Is this the consolidation? Let me see. Let me pull it down and make sure we are in the right spot. Is this it? I think this is it. I'm not sure. Yeah, and then we have that gap up there. Yep, okay, this is it. Okay, cool. So we're going to go ahead and readjust. Boom, okay. Now we're going to turn on my kill zone so I can see wherever the world New York is. Here we go. We're going to use the 9:30 opening range for our examples. So here we are. Here's New York. And the opening range is from 9:30. Let me draw the range like down here. It is from 9:30 right here to 10 o'clock. Uh-oh. Right about there. Let me drag that out. And boom. Okay, it's close enough. Okay, it's like 1 minute before 10, but we're good. Well, that's really the right time, but you get it. All right, so if we look in between this time here, we can spot the first Sarai gap right here. That is it. That's the first Sarai gap. But it's very, very, very small, and it's most likely, it's too minuscule to do anything to price, okay? So really, this is the first presented fair value gap. You might be like, but it touched it right here and came back up. It's a little too small. It affected price here, but you get what I'm saying. It's not big enough. Okay, that's basically what I'm trying to say here. It's not going to affect price in any way as much as this would. So this would be your true first presented fair value gap. So we're gonna just we're gonna keep it that color. I like it. It fits the name of the first presented fair value gap. I really do like it. The first presented fair value gap. Okay. It can be an inversion. It can be a reclaimed fair value gap. But just draw this out in time and you will see how price treats it. It's very what's the word? It's very powerful and very versatile, especially when you use it during the opening ranges or really just whenever you're supposed to use it, which would be at the beginning of the opening ranges because like I explained earlier, you want to find this gap or the first presented fair value gap at the beginning of the opening ranges. So the quote unquote whenever you're supposed to use them or find them is at the beginning of an opening range. Okay, so here is our presented fair value gap here, and as you see, we disregarded this one because it barely affected price. Okay, it came down here and went up. It barely displaced away from it. Then we came back down, completely ran through it, and as you can see, price is just not. It's not paying attention to it. It's not really what's the word? Addressing it. That's the word. It's not addressing this fair value gap really. We can see it's just it doesn't care about it. But this one here, this was like, uh-oh, we got a big boy in town. We're gonna start paying attention to this one. So we're gonna drag this out all the way to the end of the day, which is all the way over here, all the way, all the way, over here, all the way, right there. Well, I'll say that's the end of the day, right there. So now we're gonna go back, okay? Price, let's go ahead and analyze this real quick, okay? What price does is the initial 930 opening, we head higher. Now, but what do we head higher into? Swing high, and swing high. We have relative equal highs right here. And we also, what do we consider as relative equal highs? Nah, it's a little too far apart. We have short-term high here, and then short-term high here. We come into these two short-term highs here, which maybe on a higher time frame will look like relative equal highs, but we come to it. Okay, that's the whole point. We do come to it. After that, we immediately dump. After we dump, we have a willingness to go higher. We come down, purge this low, close above it. Then we come up, disrespect this fair value gap, showing a little bit of willingness to go higher. Then we create a break in market structure. Then we have this fair value gap within a break in market structure range. We come into it, create an institutional order flow entry drill. Then we come up, tap this mitigation again. So I think you already know where this is going. Price wants to go higher. Okay. Now, for example, let's say we're not taking any trades using anything else, but except for using the first presented fair value gap. That's the only time we're going to take a trade, is when we see a good confirmation, okay? And when it's using it to, explode higher. So we already know that our bias is bullish for the AM session, okay? Price finally reaches into this first presented fair value gap, turning it into an inversion. So now this will be an inversion since it's red now, okay? Whenever I make my boxes red, it's most likely an inversion fair value gap that I'm talking about. So one, if you want extra confluence, just to make sure, we have this breaker right here on the side. We have this immediate rebalance. We have this fair value gap that had an institutional order flow entry drill. See that? You do see that, right? Then we have this mitigation block. Price came into it, did not break the candles low. After that, we came higher again. Now on the 15-second, you could have got an entry. But on the 1 minute, no, there's nothing right now. Absolutely nothing. Nothing right now. You could have got in when you saw it come back down into the inversion and respect the equilibrium. If you want to see where the equilibrium is, I'll show you. And put it on P&D or premium discount. And then we drag this out. You can see how on this candle's closure, when it left it and then came back in and respected the equilibrium or closed above it, you could have entered right there. You really could have, okay? And then you could use this mitigation block as your savior and or protection. For example, let's say you did do that. You entered right here and you had your stop loss at the low of the mitigation, praying that it would, save you from the disrespect of this inversion or first presented fair value gap right here. You got your entry in, right? And then what does price do? Goes higher. But where's our target? We have no target, JJ. I know, we have no target, so let's go ahead and do our standard deviation, shall we? Just right along there, standard deviation. I'm going to go ahead and pull this out. So we got the 1 resting above, I think, this high here. Is it this one? I'm not sure. Nope, it's this one. I was right, okay. But this high right here. So it's decently close to that high. So that's buy and sell liquidity right there. Then we have all these other highs right here. But we have a bunch of accumulated liquidity right along here. I can just eyeball it right here. Just a bunch of stuff right here. Accumulated liquidity, where does it land? Let's go ahead and measure it out. Pull it out. If I can do it correctly, Jesus Christ. Wow, this is hard because it's not zoomed in all the way. There you go. But as you can see, that is a good target too because it's decently close to 1.5. So we can target the 1 or the 1.5. If you were eager, you could go all the way up for the 1.5. But this target doesn't get hit all the way until literally the next day. So since we're being conservative, and this is the beginning of the week, okay, this isn't the beginning of the week, but this is Tuesday. Okay, we're not gonna do too much. We're gonna set the standard deviation at 1. Because going up here, it even looks risky, honestly. Like, if you go up there, I feel like that's a little unrealistic, just based off how price is moving. Like, if you look at how price is moving, it's not really having that displacement or having large enough candles or a series of large enough candles for it to be like, okay, it's going to go up there. We have enough to go up here. Yeah, we have enough to go up here, but here, nah, that's a little extravagant. You get what I'm saying? Just over time, when it comes to like charting experience and just looking at candles, just having that screen time, you understand what I'm talking about. But we don't have large enough candles, and we don't have the amount of buying pressure or the amount of displacement higher that we want to see if price really wants to head up here. So we're going to target that 1 standard deviation. We draw that out. Target gets hit, giving you about a 6.5 risk to reward. Pretty nice, right? That's your first trade. It's your first trade, mind you. That's your first trade. So we're going to pull this out even more because guess what? We're moving into what is it? We're moving into the PM session now. And guess what? There's the opening range for the PM session. So what does that mean? There's a first presented fair value gap. Okay. But this fair value gap is still there. This first presented fair value gap for the AM session is still there. It is not gone. It's still there. That's why I said drag this all the way out, because it will refer back to it, especially if we're ranging. If it's ranging, if price is ranging, it will refer back to this and use it in some way, some shape or form. It will use it. As we can see here, 130 came in, created the high of the range right here. So you can mark that as our buy side liquidity right here, or just a high in general. Really, it's not really buy side liquidity, but you can set that. Then we got the low of the range, which would be right here, which is sell side liquidity. Let's pay attention to what price does. Price comes into that first presented fair value gap, or really an inversion now, but still the first presented fair value gap, which is an inversion, and respects the upper half of it, showing that it wants to go what? Up. And then it respects upper quadrant too. If you can kind of eyeball it if you look down there. As you can see, it didn't even reach the upper quadrant. It just stayed right above it. So that's showing that price wants to go higher. Another thing is that we don't want to break these lows. If you ever heard ICT say that, he said before, if price is purging highs, and if price wants to go higher, or we had the narrative that price wants to go higher, what price should do is it should barely purge any lows, barely. And if it does, it should be internal range lows, okay? As you can see here. See this low right here? It's internal range. Comes down to it, then goes up. But like I said, if price wants to go up, you barely want to see it touch any lows. You want to see it consistently running through highs. And is it doing that? Yep. High ran through. High ran through. Are the lows barely getting pierced? Are they getting pierced at all? Nope. Barely. Not even barely. Rarely. Like literally, the word Rarely. Rarely. Or is that? Yeah, I think that is rarely. But it's rarely getting tapped. I probably sound retarded spelling that. But they're rarely getting tapped. So that shows that price wants to go higher off of this first presented fair value gap. Now, what is the first presented fair value gap for this range here? It would be right along there. Did you see that, Rock? Very interesting. I know. Very interesting. I know. Very, very cool. So now this will be another inversion. We're going to pull this out a little bit more. Whoa, not like that. Along it. We're going to pull that out just a little bit longer. All right. So we know that price wants to go higher. We got this initial push up. Boom. We return back to this consolidation. This accumulated liquidity down here. This is all liquidity injection. If you don't know what that is, it's when it purges liquidity and then immediately accumulates right after. It's re-injecting those orders back into the market to reverse. So you have liquidity injection, price comes back down, taps that level one more time, because this is all liquidity right here. This is all liquidity because it's liquidity injection. Comes down, comes up, comes down, comes up, and then we finally go above this first presented fair value gap. But it didn't come back to it. That's okay. Look for something else. Look for something else. But you can use the first presented fair value gap for two things. Either for analyzation, to help you take a trade with a different PD array, or to just to assist you in general on your narrative or your bias or whatever trade you're trying to take, or you can use it for your entry, in which we did with the last trade. Okay, well, not really, kind of sort of, but you get what I'm saying. Okay, in this case, it's using it's assisting us. Okay, because price had the audacity to inverse this and was like, nah, we don't care about that. We don't want to follow the underlying narrative that this thing wants to offer, which is bearish. Since it's a bearish, right? We're like, nah, we don't want to do that right now. Price inverses it and it's like, nah, let's not do that. And then we come back above it one more time, showing that no, we really do not want to respect this. This first initial push up this heavy displacement was like, nah, we don't want to respect this right now. We don't care. We really don't. All right, we don't care. So price comes higher. I feel like once we see that real displacement higher, or we can get an entry right around here somewhere. But we got our propulsion block right about here. Did it even come to it? Wow, yes it did. Is that to the tick? I think that's to the tick. Wow, that's to the tick. What the heck? Dang, that's crazy. But yeah, you have your propulsion block right here because that was the deepest candle that went into this previous order block right about here. So you could have entered off that propulsion block, in which I personally would have. So propulsion block, and then I'll set it at the low of the order block. I'll set it at the lower order block because that's what this candle is based off of, the order block itself. So we're going to standard deviate this range higher, which would be from here to here. Boom, there we go. So we got the high of the opening range, which would be the 2 standard deviation. It's relatively close to the 2 standard deviation, but I personally wouldn't say it's not close enough. Then we got this 2.5. Wow, see that? We got this 2.5 resting pretty close. So the closer it is, the what's the word? The more yeah, I can't get the word out. But the more influential, yeah, that's the word. The more influential that level is, okay, or the more it has higher importance, okay. Price will tend to seek that level. If you get what I'm trying to say, but it's more influential, okay. It has more of a purpose. The closer the standard deviation is to a certain level, yeah, it's a good target, okay. So we got that 2.5 that qualifies. Do we have this 3.5 that qualifies? Let's see. Yep, we have the 3.5 that qualifies. What about this 7? No, we're obviously not going to go that far because you can clearly see that price literally doesn't even have the energy to do so. So what we're going to do is we're going to set it at the 3.5 mark, which would be right up here. And we're going to drag this out. Was that 3.5? I think that was. Yeah, that was 3.5. So that's a 14 risk to reward. We're going to drag that out. And price does eventually hit your target, as we can see here. Okay. Pretty cool, isn't it? I honestly did not think that propulsion block was going to get touched. But it did. And it did it to the tick. What am I teaching you, man? This is crazy. Wow, that is amazing. Look at that. I just said boing, and then your limit probably would not even gotten triggered. If you had a limit, you probably have to set a market order. I personally don't trade with limits because it's you already know the problems with that. The spread and just price in general. It probably won't even hit your limit in the first place. You know, just stuff like that. But market orders, I personally say are better. But if you're away from your charts, got things to do, then sure, do limits. But this would give you a 14 risk to reward. You're probably like, oh no, that's so unrealistic. Well, guess what? If I was on a 15-second, I probably would have got a 30 risk to reward. Okay, because I would get even smaller risk. But I'm just sparing you. I'm not gonna go to the 15-second, the 30-second, none of that. We're staying on 1 minute. Okay? Because I literally can't. I don't even have the premium and all that because I don't need to buy it. I don't have to. It's just no point. But I might buy it eventually to have the market replay thing so I can start replaying this and actually, doing this with you. But yeah, there's our 14 risk to reward trade. Very cool. Using the idea of the first presented fair value gap and using it to assist us to take this trade to confirm the entry off that propulsion block. Okay, so 2 trades, we both won. We won both of them. Pretty decent, right? You know about the first presented fair value gap. You know its purpose. You know how good it is. So I think this was a successful teaching. What do you think? I think so. Hopefully I didn't teach you incorrectly. But yeah, that's really it. I think this was about 20 minutes long. I'm not sure. Getting close to 20 minutes. I think it's like 19 seconds, 19 minutes and 30 seconds. But this is the end of the first presented fair value gap, and it's currently going on 12 o'clock. I need to go take my booty to bed because I got school tomorrow. But yeah, let me go ahead and end this here, and I'll see you guys in the next one. Good luck and good trading.